Hi everyone, we are Group Beverages. I'm Emma. Our three companies are Coca-Cola, Keurig Dr. Pepper, and Pepsi. Our group chose Keurig Dr. Pepper as our company. And now I'll show you financial data of three companies and quickly go through the data. Later I'll dive into more details for their comparison. This is their balance sheets. As you can see, over the 15 years, all three companies demonstrate growth in their balance sheets. It indicates that their scales are growing. This is their income statement. It is interesting that Pepsi had the highest revenue than Coca-Cola, but if we look back at their total equity, Coca-Cola was actually higher than Pepsi. It kind of implies their cost structures differences. Now it goes on to the cash flow statements. Pepsi was showing strong operational efficiency and revenue generation, but it had higher capital expenditures. From this, we learned that their ambition in reinvestment for growing. Now it goes on to visualization of trends. In these three charts, we can see that KDP skyrocketed during 2017 to 2018. It's because there was a merger between Dr. Pepper and the Keurig Green Mountain. In this chart, we also see Coca-Cola was and Pepsi would show similar and a stable trend of growth. And now we look at current asset and liability, we see Coca-Cola's sudden drop in 2016. According to the news, they were under refranchising of its bottling operations. When we especially look at KDP, its currently assets and the liabilities increased after 2018 merger. It stabilized at higher levels than before. Now we look at the fourth charts. Pepsi is demonstrating a strong, consistent growth. Coca-Cola still strong, but faced challenges around 2016. As mentioned, they have the franchising battle event, but they started to recovering. And the KTP, although it's the smallest, but shows steady growth. And when you see CFF chart, you will notice KTP had less negative data, and it suggests their reliance on financing. Here comes KDB's performance comparison based on the four ratio chart. KDB's debt to equity ratio increased continuously, which again reflected its reliance on debt to finance the merger or other investments. It has higher free cash flow operating margins, but lower current and quick ratios. That may imply they are vulnerable in handling short-term financial obligations. After going through the data, we conclude KDP's strength is flexibility for their future investment. Although it continuously increased debt to equity ratio, it demonstrated a good cash flow generation. So overall, we expected a good promising future for KPT. But its weakness can be the high reliance on the debt financing. Also, KDP is still smallest among the three, so that limit their market reach and ability to invest at the same level as Coca-Cola and Pepsi.
Hello, my name is Solmeg, and let's move on to task 3. In reviewing the key business drivers for Coca Cola, Pepsi, and Dr. Pepper, several critical insights emerge. Coca Cola focuses on healthier, sustainable products to meet changing demands, keeping costs low and building brand loyalty in a tough market. Its success mostly depends on innovating and reinforcing its main strengths. Pepsi has both snacks and drinks, making it more adaptable to demand changes. However, its large staff and wide product range increase costs, so it focuses on managing these costs and investing in health focused snacks and drinks. Dr. Pepper targets premium and health focused drink segments using strong distribution and a wide brand lineup. It focuses on coffee, soft drinks, and partnerships for growth, but needs to control production costs and stand out from competitors. Overall, while all three companies navigate similar drivers, each adapts unequally. Coca Cola prioritizes brand strengths and health trends in beverages. Pepsi leverages a broader portfolio to mitigate risks, and Dr. Pepper balances its beverage focus with strategic product diversity. Moving on, so Coca Cola has been increasing investments in healthier drink alternatives, including low calorie sodas, energy drinks, and functional beverages. It's also increasing sustainability efforts, especially around packaging. And Pepsi is focusing on plant based and healthy products to meet customer demand for better options. And it's also working on saving costs and expanding in fast growing markets. Pepsi is using more technology to improve its operations. Dr. Pepper is focusing on new, healthier drinks again, especially ready to drink options. It's also working on eco friendly packaging like Coca Cola and finding ways to lower costs. The company is using digital tools to improve online shopping. Therefore, while all three companies share an emphasis on healthier options and sustainability, their strategies differ. Coca Cola and Pepsi are expanding their rich food and beverage sectors with broader product portfolios. In contrast, Dr. Pepper focuses more narrowly on beverage innovation and operational efficiency, and all three companies continue to use technology to meet evolving consumer expectations. So, after studying the economic factors, initiatives, and financial impacts of each company, we want to connect the above findings to key financial ratios. And here we can see a comparison table for key financial ratios. So, briefly, Coca Cola and Pepsi maintain moderate debt to equity, while Dr. Pepper has an increased ratio due merger costs. Coca Cola leads with strong margins from an efficient structure. Pepsi is steady due to its snack segment, and Dr. Pepper is improving but still behind. And last but not least, Coca Cola has high cash flow, Pepsi is stable, and Dr. Pepper lags, but it's catching up. Overall, Coca Cola and Pepsi are more stable and profitable, while Dr. Pepper is in a phase of post merger improvement. Thank you.
Thank you, Zomac. Now I'm going to talk about TASFER. The first is key metrics for monitoring. The first is debt to equity ratio. It needs to be monitored regularly, especially for Dr. Paper, to assess the progress in the debt reduction. The second is operating margin and net profit. It is essential for tracking efficiency improvement, particularly for Dr. Paper and Pepsi. The third is free cash flow margin. It is indicative of cash generation capacity. The last is current ratio and quick ratio. It needs to be evaluate the liquidity to ensure the short-term financial health, especially during the economic uncertainty. Okay, now I'm going to talk about the actionable recommendation and the insight for strategic investment decision. For Dr. Paper, we will focus on addressing the lagging areas. It has two parts. The first is it have a high debt to equity ratio, so we need to implement the debt reduction strategy by allocating a significant portion for free cash flow toward the debt repayment. And another is a lower operating margin, and we need to enhance the operational efficiency by streamlining the production and distribution processes and invest in the automation and cost management tool to reduce overhead. And their leading area is they have a post-merger growth potential. So they can leverage the merger synergies to expand the product line and enhance market reach, particularly in health conscious and functional beverage. And this is their strategic investment decision. The first they need to do is enhance their product innovation, invest in like R&D to develop a new flavors and functional beverage. The second is to strengthen distribution to improve the logistic and partnership to expand their market share. The next is Coca-Cola. They need to maximize the leader area to addressing the slower revenue growth. Their lagging area is they have a slower revenue growth compared to the competitor. So they need to diversify further into a non-carbonated beverage and focus on emerging market. Their leading area is they have a high operating and free cash flow margin. So they need to use strong cash flow to continue the shareholder return and the strategic acquisition. They can invest in the sustainability initiative to enhance their brand loyalty. Their strategic investment decision is to expand into an emerging market and also acquisition of health-focused brands. For PepsiCo, they will need to focus on address the snack segment margins and leverage their diversification. Their lagging area is they have a lower operating margin in the snack segment, so they can focus on supply chain optimization and the raw material cost management to improve their margin, and also introduce the premium snack line to boost their profitability. The leading area is a diversified portfolio and the global presence. And the recommendation is to leverage the diversified product portfolio to balance risk and expand the digital and e-commerce platform. The strategy investment decision is to invest in technology and focus more on sustainability. And this is our reference, and this is the end of our presentation. Thank you.